Ancient rooms carved in stone, question everything I've known.
Before you buy your first stock, before you choose an ETF, before you invest in Bitcoin, and before you trust someone else's prediction, take your first steps. StepStocks makes investing easier to understand. One practical lesson, one relevant idea, and one decision at a time. This is not about getting rich quickly. It is about building knowledge, confidence, and a system that can compound over time. Follow the free learning series on StepStocks. Pull up a chair. Let's begin. Let's start with something that might take a little pressure off. You do not have to predict the future to become a successful investor. You don't need to know which stock will double next year. You don't need to guess exactly what Bitcoin will be worth. And you certainly don't need to predict the next recession, election, interest rate decision, or artificial intelligence breakthrough. That doesn't mean the future is unimportant. Investing is always about the future. It simply means we don't have to predict it perfectly. Imagine that we're planning a long trip together, not a single fixed journey, but more like a road trip or canoe trip, where we know the general direction, but not every bend in the road or every change in the current. We wouldn't begin by trying to predict every turn, every traffic jam, and every patch of bad weather. We would start with simpler questions. Where are we going? How long do we have? What can we afford? And what could go wrong along the way? Investing should begin the same way. Before choosing a stock, we need to understand what the money is supposed to do. Is it for retirement in 20 years? A home in 5 years? An emergency fund we might need next month? Or is it money we can afford to place in a promising company that may rise dramatically or fall dramatically? Those are very different trips, and money should be invested according to its trip. Money we may need soon should usually be kept somewhere safe and accessible. Money we won't need for many years has more time to recover from market declines. That gives us more room to own investments that can grow, but that will sometimes be volatile.
Does that mean we should pay off every debt before investing anything?
Not necessarily. Low-interest debt, retirement contributions, and long-term investing can often coexist, but high-interest debt is different. It is a guaranteed cost that is hard to outperform, so it usually comes first. This isn't about following one rule in every situation. It is about understanding trade-offs. A certain return from paying down debt sets a very high bar for any uncertain investment to beat. Strengthening the boat may not feel like investing, but it improves our ability to remain invested when conditions change. Our third step is to build a strong foundation. For most beginners, that means owning a broad, diversified investment, something that holds many companies rather than trying to pick the one perfect stock. A broad market index fund won't give us the excitement of finding the next great company early, but it removes the need to know which company will win. Some businesses will struggle, some will disappear. Others will grow far beyond what we can imagine today. Diversification ensures we participate in that growth without relying on a single prediction. From there, if we enjoy researching companies or themes, we can add individual investments as a smaller layer on top of that foundation. That is where StepStocks comes in. We focus on understanding the forces changing the world: artificial intelligence, energy, data centers, healthcare, digital assets, automation, and the infrastructure, the picks and shovels, supporting those changes.
If we can see that artificial intelligence is transforming the world, why not invest heavily in the companies leading it?
Because identifying a powerful trend is only the beginning. We still need the right company. We still need a sensible price. And we still need a position small enough that we can survive being wrong. A strong theme does not guarantee a strong investment. A great technology can be a poor investment if the price is too high. And a company can use popular buzzwords without having a durable business underneath. So we still ask basic questions. What does the company actually do? Does it make money? Is revenue growing? How much debt does it carry? Does it have an advantage competitors cannot easily copy? And most importantly, what expectations are already reflected in the price? We don't need perfect answers. We need enough clarity to understand why we own something and what would prove us wrong. Our fourth step is to invest gradually. Most of us will never receive a perfect signal telling us the exact right moment to invest. Prices may fall after we buy. That doesn't automatically mean we made a mistake. It simply means markets move unpredictably. Investing a manageable amount on a regular schedule reduces the pressure to time everything perfectly. It also turns investing into a habit. When prices rise, our existing investments grow. When prices fall, our next contribution buys more. Neither feels perfect in the moment, but both can work over time. Finally, our fifth step is to leave room for uncertainty. There will always be surprises. Some will be positive, others will be painful. The goal is not to build a portfolio that only works if our predictions are correct. The goal is to build one that can survive being wrong. That means avoiding excessive debt and leverage. It means not putting short-term money into highly volatile assets. It means diversifying. And it means keeping speculative positions small enough that mistakes are survivable. So our first StepStocks lesson is not a stock tip. It is a way of thinking. Know what your money is for. Strengthen your financial boat. Build a diversified foundation. Invest gradually. And leave room to be wrong. Because successful investing is not about seeing the future perfectly. It is about preparing for several possible trips and continuing to move forward when the journey surprises us. This isn't personal financial advice. It is a framework for asking better questions.
So before I ask what I should buy, I should ask when I'll need the money.
Before we finish, take a moment to complete one sentence. I am investing this money for blank, and I expect to need it in approximately blank years. That answer helps determine the right boat for your journey. Remember the 5 first steps. Know what your money is for. Strengthen your financial boat. Build a diversified foundation. Invest gradually. And leave room to be wrong. Successful investing is not about predicting the future perfectly. It is about preparing for uncertainty and continuing to move forward when the journey surprises us. Next week on StepStocks, investing versus gambling. Both involve risk. Both can produce gains or losses, but they are not the same. We'll explore what separates a reasoned investment from a speculative bet and how to recognize when excitement is replacing discipline. Until then, stay curious, keep learning, and think long-term. This is StepStocks. This program is for educational purposes and is not personal financial advice. Let consistency do more of the work. Pull up a chair. You're always welcome at our table.
I seek a path within my soul, through ice and fire beyond control. Every step I thought would save